This is the first video on chapter 14. Let's start in the usual way by going through the to-do list according to the authors of the textbook. The first tick is really important to explain why companies are taxed separately. So they spend a lot of time on that, and they also, if you look at the questions at the back of the textbook, that is what the questions are mostly about. You have to be able to define the company tax base. I want you to distinguish between classical and fully integrated company tax systems. We will talk about that. You don't have to describe the company tax in South Africa. You don't need to know the history. There's a piece on mining companies which you also don't have to worry about. The efficiency of any tax is always important. That's one of the traits of a good tax, is that it's efficient. And then the following two bullets, you don't need to know the detail of that, but you have to know the efficiency implications of that. So if a tax could change investment decisions, that means investors' behavior change, and then that is a sign of inefficiency of the tax. Similarly with incentives. So you don't have to be able to write a paragraph on incentives, but you must know that how that affects economic efficiency of a tax. Definitely the equity implications of the company tax and the arguments for and against the capital gains tax, because we have a capital gains tax in South Africa. So for you as a student of economics, it's important to know, why do we have one? They have a story about income tax reform, which I think is a bit beyond the scope of this course, so you don't need to do the final two paragraphs. So why a company tax? 14.1 is important. Now what you will see is the reasons for a company tax mostly have to do with the four characteristics of a good tax. For example, one of the reasons is because companies benefit from government services. So what does the benefit principle have to do with? It has to do with fairness of a tax. So it's just fair that people that get benefits from the government protects their property, and the government provides goods and services, and therefore they benefit from the South African services, and they should pay tax. The second has to do with ability to pay, which is also a fairness characteristic, isn't it? So shareholders shouldn't be allowed to hide their wealth or their income in the form of shares in a company. If they never take the shares out, then they don't get taxed in their persons as persons, and they are able to avoid paying tax as individuals, and therefore it's good to have personal income tax and company tax, because we want to get everybody who has the ability to pay their taxes. So those two have to do with fairness. The taxes could reduce market failures if the companies taxed are, for example, monopolies who make excess profits. And if we can decrease the excess profits, you'll remember that monopolies cause excess burdens. If we can make the excess burdens smaller, then it means the tax is efficient. So that has to do with the efficiency of a tax. Then they specifically talk about the fact that it's administratively simple, or a company tax, much simpler than a personal income tax. And so this is one of the few references to administrative efficiency, and that's a reason for the tax, because it's more efficient than a personal income tax, and it does generate revenue. Now, we will just now see that the revenue has been decreasing over time as a proportion of the total tax, all the different taxes, but it's still significant. And another reason for the company tax is that we can also tax foreign investors, because they come and invest in South Africa, in South African companies. We tax the profits of the companies. We don't care where the investment comes from, but in a way, that's a way of also getting revenue from foreigners if we have a corporate income tax. So the revenue has been declining. Now you can see that in 1975 the income tax amounted to 2,000 million, and 45 years later to 200,000 million. So in nominal terms the numbers hasn't decreased, but in real terms it could have decreased. But the big thing is that as a proportion of all the types of taxes, company tax has become less important. The reasons are various. So, nature of economic development is such that as a country develops, the importance of consumption taxes and PIT becomes more important than corporate income tax. That's one reason. The second is that it could have been factors that affect the profit margins of companies could have become smaller. I mean, you know that wages have been rising above inflation, so wages have really made it difficult for companies to keep their profits up, plus other costs and so on. Then the tax system itself could work against revenue if the tax system allows lots of exemptions, and if it's easy to evade or to avoid tax, then the revenue will also decrease. The tax rate itself came down from 50% in the 1980s to the current 27%. It's decreased again by 1% this year. So if the rate is halved, then obviously the total revenue from that source will also decrease. And the fifth reason is mining and quarrying. Mines don't make as much profits as they used to for various reasons. Some have been stolen empty, and others have just become difficult to make profits from. The gold mines, for example, have to dig deeper and deeper and deeper. That means it becomes more expensive to get to an ounce of gold and so on. So it's mining, the role of mining has also decreased. So those are 5 reasons why company tax revenue has decreased over time. The next paragraph is on the company tax structure. The first half of that you don't have to worry about. You don't have to care about the history of our company tax base. What is just important is the definition that taxable income for a company is total receipts minus total expenses which are allowed. I think it's from an efficiency point of view and from a fairness point of view, this paragraph is important, because what they say is that this could change behavior, because interest can be deducted but dividends cannot. So the way that a company finances itself matters. So if they can either borrow money and pay interest, or they can issue shares, and then the cost of that is dividends. So why would it be the case that interest is deductible but dividends are not? So that's a bit crazy, but the effects of that is that it changes behavior, and what does that do? That decreases the efficiency of the tax. It could also be discriminatory in that regard. It could be unfair against one source of finance. Depreciation is not so important, but I think the one thing that you should know, what does depreciation do? Well, it affects the effective tax rate. The faster a company is allowed to write off their assets. The bigger the depreciation rate allowed, the smaller the effective tax rate. So it affects the tax rate of a tax system. Okay, important. Just the first paragraph of 14.2.2, the difference between the classical system and the full integrated system. So what did we have in the past? So in the past, companies were regarded as entities separate from their shareholders, and both were taxed at the same income source. So the owner of a company was taxed on all his income from all sources, so he would perhaps get a salary, but he would also take home some of the profits of the company, and in the PIT system he would be taxed at the full rate. And the company was seen as a different entity, and it was also taxed. So that means the company was taxed twice, and that's double taxation. That's the old style. They quickly realized that this is not fair, so then most countries have the full integrated system, where companies just see as a vehicle, as a conduit for all company income to the shareholders, and the company income is, the shareholders are only taxed at their marginal income tax rates, and not when the dividends and so on are still in the hands of the company, which is more fair. I'm not sure, I don't think I will finish the whole chapter in this video, so let's just be safe and stop here for the first video and then continue later in the second.